Major support for these broadcasts is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, All Nation Renovation, Bingham McCutcheon, LLP, Briarwood Organization, Bruce Mosler, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Chelsea Lighting, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Investors Bank, Jack Jaffa and Associates, Real Estate Consultants, James D. Kuhn Real Estate Center at Syracuse University, Corman Communities, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, Newmark Knight Frank, Site Comply, Sterling and Sterling, SJP Properties, Stonehenge Partners, the Wickoff Group, Urban American, Ackman Ziff Real Estate, Eastern Consolidated, Goldman Properties, the Moynihan Group, Muss Development, RAL Development Services, the Spandrel Group, LLC, Triangle Equities.
So if you are a consumer, how do you get an opportunity to own a piece of real estate? The best way is to be part of acquiring stock in a real estate investment trust. So let's see what's happening in the real estate investment trust marketplace. Today I've assembled 4 CEOs, COOs of prominent real estate investment trusts, or REITs, to provide their insight on the state of the market. My guests today include Michael Papagallo, who is the Executive Vice President and COO of Kimco Realty; Neil Shah, who is the President and COO of Hersha Hospitality Trust; Patrick Callahan, who is the President and CEO of One Liberty Properties; and last but not least, Ken Bernstein, who is the President and CEO of Arcadia Realty Trust. So you're the local. We brought him in from Pennsylvania. You from the two of you from Long Island. So how do you see the REIT world today? You know, it's had an ups and downs on the stock market, but we're not talking about the stock market. How do you see the REIT world today with regard to the properties that you own and operate?
Our assets, about 2/3 of our assets are from DC through to Boston. And then we have a fairly large street level retail portfolio in Chicago and redevelopments ranging throughout the eastern half of the US, down in Miami Beach, is another example. In general, for commercial real estate, we're seeing very steady results at the property level, combined with a lot of volatility at the stock price level. More to do with the global financial concerns and the general volatility in the financials. So it's really been a disconnect between steady as she goes in terms of our real estate and then a lot of volatility in the equity markets.
How are your tenants? Because, I mean, Kimco this year, you rang the bell at the stock exchange. It's really the 20th anniversary that when you went public this year. How does Kimco look at your retailers doing in your shopping centers?
Well, and to that point, Mike, I think the one statistic about our portfolio says it all. The national or regional retailers that take space over 10,000 square feet, we're 96% occupied. For the mom and pops, generally under 10,000 square feet, 82% occupied. And that, from the standpoint of retailer activity and our particular tenants, is the tale of two cities. Most of the national retailers are quite healthy. They've repaired their balance sheets. They are growing. You can see many of them have stock buyback program, which tells you a little bit about their cash flow generation and what they're doing with it. Whereas many of the smaller tenants that have less octane, less access to capital, they're having a difficult time. And I think that's reflected in most shopping center portfolios today.
Now, here's a question because Patrick also has some property which is in the retail market. How do you see, have you been able to absorb the losses of the Borders, of the electronic stores going out of business today? And I don't know what effect the Filene's Sims is going to have, because they had most of their own locations over there. Do you see the absorption by other retailers?
I think slowly those other retailers that have had fallout with respect to the last few years have been slowly absorbed. I think the well-located retail boxes tend to go quick. You see the flaws in the real estate that's not very well conceived. It's got some fundamental retail lacking of demographics or traffic counts. I think real estate fundamentals have come back, and where real estate fundamentals are sound, the boxes move quickly.
I think Mike was on a show a number of months ago with me, and I was discussing the changes of retail patterns. And I even wrote an article recently about this, and I was saying, 15 years ago, there was something called Sam Goody's. And I recently looked at their earnings report, or their loss report, saying that they're really out of business, and Blockbuster is really in a difficult shape today. So the changing face of retail, who's replacing these retailers in those stores who are no longer needed? Then we're going to get to hospitality in a second.
Well, what I can tell you is that the strong are getting stronger as it relates to replacement boxes. If you think about discount apparel, a TJX, which includes the TJ Maxx and Marshall's formats, very strong. Ross Stores is growing. When we came out of the recession, some of the largest absorption of our mid-tier boxes came from Nordstrom Rack as they continued to expand in close proximity to their Nordstrom stores. So you do continue to see some evolution and expansion of the stronger retailers, and they've started to replace the boxes. What can't be lost, though, is the fact that since the recession, there has been virtually no new development. So the supply and demand has started to reach a certain equilibrium, which didn't exist 3 years ago.
And look at the difference about development. Hospitality. I mean, how many more rooms is New York City going to build? I mean, each and every day there's another hotel opening up. I mean, there was a time that we didn't have anything, and this year we're up to 90,000 rooms, and we've definitely added at least 12,000 rooms over the last couple of years, and there's another 10,000 in the pipeline. How do you see the hospitality market?
There has been a lot of new supply relative to especially the last, the last 5-7 years. But I would say two things. One is that a lot of the new supply that we've seen enter the market in 2009, 2010, and a bit this year in 2011 were often projects that got started at the last cycle, the last peak, and there was more financing available than any time before, especially for hotel financing, which until the last peak was still usually the untouchable part of hotel or real estate construction financing. So we had a point in time where there was a lot of construction lending done. That is kind of building out. Last couple of years, we saw it and felt its impact on properties. But this year and now for the next several years, we're expecting generally relatively moderate growth. It's a couple of % of new supply growth for the next 2 to 3 years, which is keeping with long-term supply averages. You have to keep in mind that New York City is still more than 80% occupied. It still has the best fundamentals of any lodging market in the United States. And as a city, New York still has less hotel rooms than Paris, Las Vegas, Orlando. The list goes on and on. So it's you look at supply and demand. This has a lot of demand in this market that's actually many nights of the week. You can still not get a room. And so we feel okay about it. But that said, it did temper performance the last couple of years.
Now, your building in downtown Brooklyn, Neil has one hotel in downtown Brooklyn. Downtown Brooklyn has been a traditionally excellent retail marketplace. How do you see the boroughs with regard to everyone over here, the boroughs and the suburbs, in today's market in your world?
Well, first of all, New York rebounded from the financial crisis a couple of years ago in a much stronger way than we thought. And the boroughs historically and even to date have less than half the retail per capita that the rest of the United States has. So there's a better value proposition in terms of retailers wanting to come in. You mentioned Brooklyn. Brooklyn on its own is the 4th largest city in the United States. Brooklyn has become a very popular place to live, to work, to play. So we are starting to see all different types of product use receive pretty strong demand. It's one of the few places that new development, I think, can make sense. It's one of the few places that we find our national and international retailers very excited about coming to. So Brooklyn is a little different than the rest of the United States. Brooklyn is probably a little different than some of the other boroughs, although we're seeing strong demand in the Bronx, we're seeing strong demand in Queens. We're involved in all 5 boroughs, and it's a good place to be an owner of retail properties.
And for lodging, Brooklyn is great. I think for lodging, there is this impact of kind of compression, and I think in the last cycle, even hotels in Queens, in Brooklyn, out at the airport, in northern New Jersey, all enjoyed a great cycle last time. I think this time, with the new supply that's come into Manhattan, I think as you start to stretch out into the boroughs, we haven't seen a recovery in northern New Jersey. At JFK Airport, we've seen a good recovery. At downtown Brooklyn, we've seen a good recovery. But I think some of the hotels that are kind of outlying in further areas, kind of closer to Queens, Long Island City, the far reaches of Brooklyn where there was a lot of new supply, there I think it's still challenging. But if you're at Main and Main, you're where people want to live, where the office tenants are, and where there's solid transportation infrastructure, it's a very strong market.
How do you see the suburban markets today for your type of properties that you've been acquiring?
I think well-located real estate, even in secondary, even tertiary markets, is a good bet. But you've got to do your homework and understand, the immediate submarkets. I'm very comfortable with buying in suburban markets right now.
Michael?
That's pretty much what we have been doing throughout most of our history, both public and private. We probably have a presence in maybe 50 MSAs, but our focus from the business perspective is in really 30. 30 that both encompasses the top 20 MSAs as well as 10 other that where we have a significant presence. And for us, it has been about focusing on infill dense locations where there are large barriers to entry. We like to show a stat that about 90% of our real estate is located in first ring suburbs. So most of it is mature, established neighborhoods, be it power centers or neighborhood and community centers or grocery anchored centers. That's where we've made our money, that's been our history, and that's where we'd like to stay.
Over the last couple of years, REITs have been able to obtain a lot of money from the capital, from the stock market for financing. I know you recently just put together a line of credit for close to $2 billion, and so on. Has that market, are you going to the street to get financing, or is it better to go to the street than to go to the conventional banks and insurance companies as a REIT executive?
From our perspective, and Acadia is a little different in that although we do tap the public equity markets periodically, and we did so relatively recently for capital, the majority of our growth capital comes from a series of fully discretionary funds that enable us not to be overly beholden on the public markets. So we look at both secured and unsecured debt and public as well as our discretionary funds to fuel our growth. And it depends what's going on in the world. Right now, the public equity markets are very volatile, so I wouldn't want to be solely beholden to it and try to raise equity at a bad time. We've seen REITs get into trouble being forced to do that. But
I think I'm talking more, on Michael, I was really talking specifically more on debt raising. Okay, I'm talking as looking for debt.
Once you get to it, and Michael can talk about Kimco's point of view, if you can borrow carefully on smaller portfolios at the secured real estate level, it can be a very effective way to borrow. I think for the very large companies, that becomes less tenable, and then they look to the bond markets instead.
At Kimco, we like to tell the story, whereas during the depths of the recession, 2008-9, when we went to visit the commercial bankers, the money center banks, you'd meet them in a nondescript conference room on the 13th floor. Now, you're back up to the top floor, having lunch with the white-gloved service. So that's how far and how things have changed with respect to the commercial banks wanting to give the more well-capitalized REITs money. Clearly, they are pursuing the higher quality names. They want their exposures to be with companies that they know they're going to get repaid. So the bank market, as a general statement, is wide open. To Ken's point, the unsecured market is an available source of capital. It was somewhat of a hiccup until recently when Simon and Boston Properties went out and reestablished the market. And I think over the long term, there is a meaningful amount of money to come from the unsecured market.
What about your approach?
Mike, I would say in lodging, we've been, I think one of our advantages, and among a lot of the lodging REIT players, has been to be all cash buyers. The debt financing markets for lodging have yet to recover. The CMBS market has been kind of opening with fits and spurts, and it will get going again, ultimately. It needs to. But in the meantime, REITs have had a very significant advantage versus private equity or versus private kind of regional owners and operators in acquiring assets. Without debt available, assets, especially institutional grade, kind of urban gateway kind of assets, are generally $50 to $150 million in value. It's very unlikely you can get any more than 40 to 50% debt on that kind of acquisition. And so we are getting to the point, I think, at least in lodging, that we're going to see more and more consolidation. There isn't as many players that have access to, all equity financing or 50% equity financing for most acquisitions. And it's great that the REIT.
But I think you just brought up a very interesting thing. Do we see because you're basically a retail REIT. You are only a retail REIT, okay? You're a triple net lease type of thing. You're in a variety of things. Do you think we're going to see in 2012 a consolidation of some of the REITs? Are there going to be, like this year, the hospitality REITs have been very hungry buying a lot of assets. They've been buying assets, coming into New York City, over here, buying assets. Do you think that there'll be a consolidation of these smaller REITs being acquired by the larger REITs? Just in general.
Do I think it should occur? Yes. Do I think it will? Probably not.
Why won't it occur?
It goes down to what we euphemistically call social issues. The REIT board and the REIT management team has got to be motivated and want to do that. And too often we see REITs that have been struggling historically continue to stick around. It also probably doesn't matter. The amount of real estate in our space that's owned by the public is just one small segment of the entire universe. So if there's no consolidation, we can still grow just fine.
But here's an interesting situation. In 2011 in New York City, a number of residential properties, UDR came in from Denver and started to buy over an enormous amount of apartments. Now, part of the reasons that they bought the apartments is that they went to certain owners and offered them stock as an opportunity. It's great for estate planning, which was very good for, Kimco going back for other ideas. Do you see that maybe there's a possibility for Herscher or One Liberty or your company or Kimco to go there and go to a owner of certain assets, hospitality, retail, or even, a variety of buildings, and say, hey, I can give you stock, and this is a great opportunity for you for estate planning, for tax planning and different opportunities, plus you can own a piece of the whole, as don't worry about the headache.
Well, not stock, but operating units.
Operating
Obviously
units,
a key
right.
differential for a tax-sensitive seller or contributor, because it's not a sale. But I think one of the issues from Kimco's perspective, we're not an UPREIT, so we need to avail ourselves of specific structures on a property level that would gain the same sort of tax result. That has some traction. We've done a few of those sort of, quote, down REIT transactions. But I think more than anything, it comes down, as it always does, to price. And for the better quality properties, there's clearly has been and continues to be a bifurcation between the A properties and the B and C properties. So the A properties seem to be getting more and more expensive, fueled by obviously where the capital markets are. So when you're trying to structure a transaction with a tax-sensitive seller, you sometimes ask yourself, well, where's the discount for the tax structure that avails you for the deferral of taxes? And we're really not seeing that. So there's some activity, but not a lot.
Neil?
We haven't used OP units for any transactions in the last couple of years. We did several years back. I do expect that this coming year or two, there will be that opportunity, because in lodging, at least with a lot of the very kind of the top institutional assets that were perhaps recently built, it's very hard to see equity for a seller, but they do need to do something. Their financing is coming due, or their brand is requiring them to reinvest a lot of more capital. So the idea of a hope note, or the idea of getting some OP units and getting to ride the new owner's benefit over a diversified portfolio, I think does hold some value. So I think we'll see a bit of that in lodging in the next couple of years.
Pat?
We have not done up-REIT, down-REIT structures. We've tried on a number of occasions. I do think it's also a function of the debt market. To the extent the debt market's opening up and CMBS is back in vogue, that's another alternative that a long-term holder may have and may just pass on the other tax-sensitive nature.
We announced a transaction earlier this year that had OP units as part of a street retail portfolio in Chicago that we were excited about, where the seller had significant tax gains, and OP units were a decent way to be part of the solution. But I think what you're hearing across the board is the devil's in the details. We'll have to see if this grows. Some of it will depend on people's view of taxes. If they think that tax rates are going up, they may be more inclined to sell for cash and recognize the taxes now. So we'll see.
Here's another question. In the similar manner that all of your companies became REITs, do you see in 2012 owners of property trying to go to become, establishing themselves as new REITs?
The track record in the last year or so has not been good, particularly on the retail side. And I think it will continue to be a struggle. In this investment climate, as volatile as the markets are generally, the investors who will make or break a successful public offering really want to extract some value and are quite picky. And I think some of the failed launchings of IPOs, and again, speaking just on the retail real estate sector, have been the consequence of investors really wanting too much relative to what the issuing company could and can provide.
Anyone else?
We've had 3 or 4 new REITs in the REIT lodging in the hotel lodging space. None of them have reached their IPO price. They're all down from 20 to 30%. So I don't see it happening in lodging.
What about the private REITs? You know, there are a number of these private REITs who raise money through the private placement system, you know, through the stockbrokers. It used to be the tick mechanism and so on. Do you see that happening? I mean, because CBRE investors, Wells, and other, I'm not specifically saying industry specific, but they're still raising a lot of money. People are paying the $10 and they're saying, you know, there's a 5% coupon, even though how they created the 5% may be, you know, a variety of ways. Do you see that as a market in 2012?
Probably. I mean, unfortunately, the rap on private REITs, and I think it's a fair criticism, is that they are so-called sold, not bought, meaning that financial advisors are paid very heavily up front to sell this to the investment community. And that probably puts an unfair going-in load on those investments. The investors are often less sophisticated, non-institutional investors. There's less transparency, and there's absolutely less liquidity. Doesn't mean that there's not good private REITs making good, sound investments. There are. But the structure has to be watched carefully, and sooner or later that needs to be cleaned up. Once you do that, is there a market for, and will there continue to be a market for people seeking yield without the volatility of the daily public trading and looking for a good, safe dividend? Sure. And I think you'll see some of that.
You know, one of the reasons that, you know, as I stated at the beginning of the show, people invest in REITs is because they'd like to own a piece of real estate and they like the dividend. How, you know, what is a reasonable dividend return in today's market for an investor?
I think you have to look at the 10-year Treasury and extrapolate off of that. So the 10-year Treasury is
2.02,
2%, or lower, and so a 3% plus dividend ought to be one that a company can pay, maintain their tax status, and you ought to have confidence that they're retaining earnings and have the ability to grow. Once you start talking about 5%, when you mention the private REITs, either you're talking about a lot of leverage or companies borrowing to pay their dividend, and that lacks a certain amount of discipline.
I think the other point about dividends is now that we've gone through a volatile cycle in the REIT land, I think it's becoming apparent that the dividend needs to be a greater proportion of the total return delivered to REIT shareholders. There was a period of time in the last decade where the total return was coming primarily from stock appreciation, and I think there needed to be, and there is a rebalancing going on. It was a painful rebalancing, but dividends and that constancy of cash flow coming off of the REITs needs to resume its prominence in terms of the REIT investment strategy.
Lodging's generally been 300 to 500 kind of basis point spread to Treasury, so a lot of we're paying about a 5% dividend. We feel like the volatility in lodging requires a higher cash flow yield, and it's been a part of our story since we went public. So I think we'll continue to be aggressive dividend payers.
Patrick?
Generally, the smaller REITs are trading a dividend yield in the 6 to 8%. It's a function of a little less liquidity than other larger REITs, and I think that'll continue for 2012.
So with like 30 seconds left, how do you, and you really don't have much time, how do you see 2012 for the REIT world? Positive?
Fundamentals, positive, slow and steady as she go, but I have to take a flyer on stock market volatility. Who knows?
Neil?
I'll say that the fundamentals will continue to be very, very strong, and I will take a flyer on the stock market fundamentals. I do think that a couple of quarters of very strong earnings growth will kind of dispel the notion that we're going backwards in time.
Quick, Pat.
Generally, in a cap rate environment going skinnier, you have to be very careful with your real estate selections, and this is a good season to be doing that.
Well, Ken.
It's going to be a good year for REITs because we're going to be able to acquire and grow when a lot of other groups can't.
I'd like to thank the REIT experts for being here, Michael Papagallo, Neil Shah, Patrick Callahan, and Ken Bernstein. See you next week.